Well, taking a look at the markets again, we saw the Dow hit another high yesterday in this session, up just about 68 points today. But our next guest says it is time to lower those great expectations and position your portfolio accordingly. Let's bring in Kristen Bitterly, Citi Global Wealth Investments in North America head. And Kristen, you laid out pretty clearly here to say this is not going to be a repeat of 2021 or 2020. What do those real expectations look like in the year ahead?
So I think the thing that we have to start with, though, is what exactly happened in 2021. 2021 was a spectacular year. You're talking about close to 30% returns in US equities. The highest peak to trough drawdown that we saw throughout the entire year was about 5.2%. In an average year, we see a couple of those. And I think the highest daily drawdown was just a little over 2%. So we saw spectacular returns. We saw very low volatility overall. And about a third of the trading days, we had the market hitting all-time highs. To put that into context, that's more than the entire decade of the 1970s or the 2000s. So 2021 really set the stage for a very, very strong year. 2022, we are still constructive on markets. We believe that the expansion is going to continue, but it's simply not going to be as easy. We're going to see, instead of profitability growth at 45%, we're going to see it in the ballpark of 7 to 8%. That's still strong. We are still seeing earnings growth, but it's just going to feel very different than what we've experienced over the past year or even 2 years for that matter.
And Kristen, I guess when we talk about themes for 2022 beyond, I guess, the macro ones and digging into what the best plays are going to be, I mean, how do you see maybe this shift away from the leaders last year into this new normal of who might lead the way this year?
This is really important because I think when we started the year at 2021, there was a lot of discussion around kind of COVID winners, COVID losers, playing a mean reversion trade or a snapback trade. That's no longer going to dominate markets, in our opinion. And so where we've been shifting our portfolios and really making some changes is into long-term leaders. It may not sound that exciting, but we're leaning into quality. And so where we want to be, it isn't a sector play. It's not a value over growth. It's basically companies with strong balance sheets who have been consistently growing their earnings. They have strong free cash flow generation and have been growing their dividends as well. And there's representation across all sectors there. And ironically, from both a valuation standpoint as well as a relative entry point compared to the rest of the market, these types of companies have lagged anywhere from about 15% in the US market to north of 20% in the global equities market. So that's an area, given this point in the cycle, where we're investing.
So, Kristen, that seems to go against what we've heard from so many guests who've said, look, it's time to rotate out of these high growth names because interest rate hikes are going to hurt them. You're saying that you have to be a little more selective, but this doesn't mean a complete rotation.
Exactly. So you have to be more selective, and there's going to be a differentiation between winners and losers. So something that was dominating the headlines earlier this week is you look at the market cap that Tesla added, right? So the $160 billion, that is basically larger than the average market cap of your average financial company, right? And so the question really becomes, when you're looking at those companies that show an outsized percentage of market cap, they're in that position for the most part because earnings have justified that. So where we see that balance of earnings actually justifying the representation, and a really interesting stat is at the beginning of 2021, when we were looking at those forward PE ratios in the S&P 500, it was trading around 23 times earnings. Now it's actually trading, it started this year at 21 times earnings. From a relative valuation standpoint, we're actually at a better level because we've seen that record profitability. So the thing to keep an eye on, especially as we're going to get into Q4 earnings, we've heard this from management teams. How is inflation impacting? How is rising rates? How are some of these supply chain disruptions? But those companies that have come in that are prepared and really shored up their balance sheet, they're going to be in a position to continue earnings growth going forward.
And then lastly, I mean, when we talk about the other swing factor, of course, the Fed shifting their tone to wrap up the year. And now you have everyone looking ahead to whether or not they're going to follow through on 3 rate hikes or not. And we've seen the 10-year yield really bouncing around to kick off the year. I mean, how are you looking at all of those moves and extrapolating out into how the market might respond to some of those moves by Jay Powell and co?
Yeah, so there was a pretty obviously big pivot in December, I think, and also a very large movement to start the year. I think Monday shocked a lot of people in terms of the movement that we saw in the 10-year. I think to put it into context, the 10-year is basically back up and trading around where it was around Thanksgiving. And so you had Thanksgiving, you had the 10-year at around 167, then the news about Omicron hit. And so some of that volatility makes sense. I think there's also a little bit of a rush. We've seen some pretty monster corporate debt issuance to start the year as well. So it seems like there's a little bit of, okay, let me get in before it's too late. Let me get in and basically kind of lock in these rates in terms of debt issuance, in terms of mortgages, things like that at the very beginning of this year. So I think this week isn't necessarily indicative of what we're going to see throughout the rest of the year, but we do have expectations that we're going to see the 10-year probably at the end of this year around 2%. So we do believe that we're going to see higher rates, but there should be some decent volatility over the next several weeks. And I think we need to kind of have a full start to 2022 before we start to see some of that rate volatility stabilize.